Hi there, it's Martin Godfrey Legido of Acquisition Assist. And I'm here today. I want to talk about vendor financing as a subject which many people really don't understand terribly well. Let me compare it with something that you probably all are familiar with, and that is residential purchases. And let me say that with residential purchase these days, back in the day, 10, 20 years ago, there was a lot more flexibility in that too. But now there is not. Government rules have changed, laws and so forth. With commercial property, there is more flexibility than with residential, but still nothing like as flexible as with purchase of a property, acquisition of a property. Sorry, acquisition of a business is very hot here. It's a little bit, yeah. So let's deep dive into it and let's get started. So, what is vendor finance? It's a tactic with business purchase or business acquisition that is well accepted, it's well understood, and is accepted by all the market. Now, whether we're talking on market deals through a broker, an accountant, or a lawyer, or off market, dealing directly with a vendor, they will, of course, typically bring in their own lawyer at some point or accountant to support them. Um, so, what's it all about? The market accepts that to buy a business of typically any size, if it's a really small business, something below 100,000, for example, the vendor would have every right to expect that most of it would be paid upfront when you actually close the deal. But as soon as you get to values of 500,000 and above, up to multi-million, then the vast majority, and in our experience, others may have different experiences, but with our experience, we're looking at well over 90% of businesses are prepared to engage in vendor finance because otherwise they're not going to sell the business. Now, vendor finance is a situation where somewhere between, let's say, 20% of the value of a business up to 50% is paid when you sign the agreement, yeah, the SPA or the final contract. So that will be paid up front, and the balance will be paid over typically 2 to 5 years. Now, some people come to us and say, "Well, look, why can't we pay over 10 years? If they want X amount of money, let's pay them over 10 years." Well, one can try that, but our experience over many years is that the average vendor will not, the average vendor, the average seller will not accept that. For them, 2 to 3 years is normally very acceptable because one can see, the human being can see 3 years ahead. 5 years ahead is getting a bit dubious because many of the vendors, they may be boomers, my generation, and they may be thinking, well, what's going to happen in 5 years' time? Where will I be? Will I still be healthy? Etc. Etc. So, but 2 to 3 years is acceptable, and 2 to 5 years is typically acceptable if the vendor is motivated enough. Okay, so I'm not going to go into the method of financing the initial 20 to 50% deposit, but let's just say, let's keep the numbers very simple. Let's say it's a 10 million pound business, or keep it even simpler, a 1 million pound valuation business, which we've valued, the vendor has agreed, and that's where we are. And let's say we're putting in 40% finance from the assets of the business, 40% down as an initial deposit payment. And the balance, 600,000, is going to be paid over, let's say 4 years. Okay, so that means we're going to pay 150,000 every year for 4 years, and that will complete the £1 million purchase. How is that organized? How is that structured? Well, what we do is, and with all our experience in PwC, JP Morgan, Morgan Stanley, and so forth, we do it for the SME market in the way that the big boys do it, which is the accepted, structured way. So we're looking to make sure that there's sufficient profit Now, profit, don't forget, can be EBITDA, earnings before interest, tax, depreciation, and amortization. It could be profit after tax if you're doing a price earnings calculation. And that, Warren Buffett would say, is the most accurate way of valuing the profit in a business, profit after tax. Because at the end of the day, that's not quite what's going to be generated in cash because you've got depreciation in there, possibly amortization, which are book transactions. They're not cash transactions. But Warren Buffett and Charlie Munger, rest in peace, would say that that's the most accurate way of doing it. But most of the market works on EBITDA. It could also be profit before tax, which I quite like as well. That's a very good metric to use. So if you're going to pay, coming back to our example, fairly simple example, if you're going to be paying 150 grand a year out of the profits, remember this will be cash because profit doesn't always mean cash. Don't forget that. There are items in there which are book entries and not real cash. So if we're paying 150 grand cash out to the vendor, the original owner, every year, we're going to want to have at least 250,000 to 300,000 of profit. And I'm using the profit in the broadest sense so as not to confuse and not to make things more complicated than they need be. And so if you've got 300,000, yeah, that means that you've got the money in the business to pay out that vendor finance and still have plenty to pay the owner, the new owner, the purchaser, yourselves, pay them salary and possibly even dividends as well. Although you have to accept that once you're paying out the deferred consideration, the business isn't going to be as profitable as you would like it and you will expect it to be. But I would say that's a sensible sacrifice because the vendor, the seller, is actually paying for you to buy the business. Do you get that? Yeah. So not every business will bear vendor finance. If there isn't the profitability in the business, then let's say the business is only making 100,000 a year and you've got to pay out 150,000, it's likely you're not going to do it. Again, we have to do the calculations because there is issue non-cash items in there. But if we work with EBITDA, let's say the EBITDA is only generating 100 and you've got to pay 150, it's not going to work, is it? And in other words, servicing of the debt service will not work. Okay. I'm not going to complicate the matter by looking at the debt that you may well have raised to finance the 400,000 initial deposit. So not every business you can do this with. The business has to have good assets. The business has to be profitable, depending on the scale of the business, of course. And that's important to understand. So now I think I'm going to sneeze in a minute. There's a lot of pollen around at the moment. Now let's look at the types of vendor finance. Let's just have a quick coffee. So there's two main types, yeah? Deferred consideration, often guaranteed deferred consideration, coming back to our example, whereby we have 150 grand to pay out. Now, in the final sale purchase agreement, share purchase agreement, you're going to have the amount of 150 grand a year. Okay. Now that can be enshrined in the contract, which says that you're going to have to pay that 150 grand every year. Okay. And you only want to do that where you're really, really confident when you've taken over the business, probably with the existing owner carrying on and supporting you for the changeover. You only want to do that when you're absolutely sure that the business profits are going to go up and up and up, or at the very least stay stable, So you're going to have the funding, 150 grand to pay back to the owner. Do you get that? Because if not, you want to look at, well, firstly, let me just qualify that. So you've got guaranteed deferred consideration, which is a fixed amount to be paid. You've just got deferred consideration, which may not be guaranteed, and the lawyer could put that into the contract. Um, and then there's an earnout. Have you heard of an earnout? Some yes, some no. Now, an earnout is where we set up KPIs every year, performance milestones of how much profit, and again, I'm using profit in the widest terms so as not to confuse. The profit will be set up going forward based on what they've achieved to date, not on what the owner says, oh yeah, we should do this, that, and the other, unless it's checked out in due diligence. We need to be conservative, but if they've been doing, let's say, 200 grand EBITDA for the last 3 years, and remember, you don't want to just take 1 year. They might have had a good year, but the previous year not so good. The next year may not be so good. You need to take that into account. What we do is take 3 to 5 years average. Now, many owners don't like that because they want you to take maybe the latest year, which has been the best year. And so we take an average and if they say, okay, we've just taken on a new contract with BT or with Tesco's or whatever, fine, we'll take that into consideration and we will plan forward as to what we think the profit will be. And then we will say, we're going to pay you your 150,000 a year for the next 4 years, as we said, over these profit levels. However, if the profit goes down, then we're going to be considering reducing the amount of earn-out payment that we pay you because there will not be the profit there to pay you that amount of earn-out. Yeah. However, the upside can be presented as well, and that if you actually earn more than the amount of profit and you get a higher level, then we'll pay you a bit more than 150. Maybe we'll pay you 170, 180, even 200,000. Therefore, bringing back the length of time it takes to pay. I hope you're getting the idea here. We recommend an earnout for our buy-side clients because it protects your interests. You don't want to. We had a client who went away, had started with us, went away and came back, and she'd put forward a deal with only an upside for the seller. And the seller liked it. Yeah, if you make more profit, you'll get more money. But she hadn't worked out the downside. And to mention Richard Branson, one of them, always protect the downside. And that's very sage advice. And so she hadn't done that. So we had to renegotiate the whole thing with her because, on the downside, you can get into real trouble. So an earnout is giving the flexibility on the profitability to perhaps pay more if the business flourishes or less if it doesn't. Now, just because it goes down in 1 year doesn't mean to say the following year the corrections are made, the profits go up, and you can recoup perhaps the amount that you didn't pay on the first year or the second year. So it gives more flexibility. So there are other, coming back to the theme of this talk about vendor finance, there are other more subtle methods around vendor finance that can be worked on. You can include shares in there some way. These are not so normal, but there are creative ways of working around them. But I'm giving you the basis of what's happening here. So just remember, vendor financing is absolutely normal in the mergers and acquisition market. It's the big caps and the mid caps and also the SME market. Everybody expects it. So if you have anybody telling you, a broker, a lawyer, whatever, oh no, 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 we don't want any of that vendor finance, then don't believe it. We should put it forward. We always put it forward. And it is a very sensible way which can be tax efficient for the seller because they're not getting all the money in one big lump up front and paying a huge amount of tax. Um, it's a very sensible way for the business if it's structured correctly. It's a sensible way for the buyer because, again, for tax reasons and so on and so forth, and above all, for commercial reasons. So, vendor finance is a very, very useful tool to have in your kit bag when you're out there looking to acquire a business. So, this is Martin Godfrey Lahido signing off. If you want to have a personal chat with me, you can easily book through our website, which is acquisitionassist.com. Many thanks. A pleasure.